Alright guys, so this will be a concise and easy to understand in my view price action tutorial on another trading strategy of mine using 1 minute time frames. Now I think that within the next few minutes you will be able to learn a simple and yet an effective way, always in my view here, effective way to spot high probability trading opportunities. But first things first, let's briefly talk here about what price action trading is. In a nutshell, it is a method of analyzing the market based on the movement of price alone without actually using a bunch of indicators or other external factors. This type of approach literally focuses on understanding how and why prices move in a certain direction rather than relying on lagging indicators that simply follow the market trend. And guys, I'm not saying here that all indicators are useless. In fact, some can be quite beneficial. However, it's true that many are laggers. On top of that, if you are a scalper, they can get you caked real fast. So that's why I'm saying that it's important for you to understand that choosing indicators that enhance your trading strategy under specific market conditions, it's important. Now let's move on to discuss why we will be using the 1 minute time frame for this particular strategy. Well, the fact is that while many traders prefer longer time frames such as 15 minutes or even daily charts, the 1 minute time frame offers, in my opinion, a more refined or detailed view of price movements and allows traders to enter and exit trades quickly. This is especially useful for those traders who are actually looking to make money on short-term price fluctuations. So what is this trading strategy? In my opinion, the trading setup I refer to as decoding market vulnerabilities and manipulation is straightforward yet effective. It begins with a solid understanding of market structure or formation, which obviously involves observing market trends. This observation, in turn, helps us determine whether we are in a trending or ranging market. The strategy at the same time pinpoints key price levels and recognizes price patterns or changes in volatility. Building on this, it's crucial to remember the teachings of Wyckoff, highlighting that price movement exists within two market cycles, consolidation and trend. Consolidation obviously signifies a balanced market, while a trend indicates an imbalanced market. By integrating these concepts, we can actually enhance our skill in terms of spotting signs of market weakness, effectively bridging at this point our understanding of market structure with the effectiveness of Wyckoff's market cycles. Once you have established a solid grasp of the market structure, the subsequent move is to determine a market bias. This basically sets the stage for recognizing key areas of interest and obviously value, which are crucial in terms of formulating your trading strategy. Following these steps, you are now ready to look for an area of interest. The optimal route to this area is obviously the path of least resistance, employing a mix of market structure breaks, imbalance zones, and various technical patterns to direct your search. In my view, this approach strikes a balance between pattern recognition and effectiveness. It helps you as a trader to leverage market trends without actually getting entangled in overly complex strategies, thus increasing the green aspect of your trades. All right, let's now dig into the intricacies of this NQ 1 minute chart. We start with a nice accumulation phase, which sets the stage for a surge of 20 points. Following this dynamic markup phase, we witness what I think is a strategic reversal in the market's direction. I say strategic because at this stage, the smart money stop offering the price at this specific level, and what they do instead is that they begin repricing it lower, a tricky maneuver clearly designed to control and manipulate trader sentiment. And as the chart clearly demonstrates, this ploy is definitely effective. Upon close inspection, you'll notice a shift and subsequent decline in price. At this point, after this low impact retracement move, the market undergoes a significant decline, sharply dropping in response to a strong supply bar, which is clearly more like a capitulation bar. So I think that this pivotal moment doesn't just lead to a significant break in market structure, but also, and with the printing of this new structural low down here, it demarcates our trading range. This newly formed range provides us now with a valuable clue in terms of the underlying architecture of price action. What I'm trying to say is that the establishment of this trading range helps us to identify important price levels, form a market bias, and more importantly, look for trade setups along the path of least resistance, which typically means aligning ourselves with the prevailing trend. Speaking of the path of least resistance, now it's logical to assume that such a dramatic repricing would exhaust all sellers, thereby paving the way for a more robust and sustained upward trend, as is the case with this section of the chart. This scenario would indeed, I think, hold true if we were dealing with a measured or controlled price deterioration. However, in this context, we find ourselves facing an abrupt market nosedive, a clear deviation, obviously, from the norm. So this pronounced downturn, which is clearly a strong sign of market weakness, suggests that any upward movement, including these higher lows that fail actually to generate new highs. So all these balancing, I think, dynamics here create a false impression as to the real direction of the market. Another thing to consider here is why the price spends such a short amount of time at this specific level. The reason lies in the significant imbalance in supply. Obviously, if the supply was not so disproportionately high, the price would have remained at its lows longer. Since the price spent such a minimal amount of time at that level, we conclude that there is a substantial supply surplus. Therefore, we would be tempted at this point to sell short when the market bounces back to this level. In my opinion, this scenario clearly dictates that the true trajectory or bias of the market is inclined towards the downside. I think that, again, this market dump here, which shapes and influences the structure of this entire trading range, offers an important analytical perspective that does in fact reveal the complex game of strategy and manipulation beneath the surface of market trends. Obviously, if you'll be able to spot these underlying influences, you can actually navigate the market's volatility with better precision. And another thing here, guys, I think that it's important for you to understand that the key driving forces or elements in the market are not arbitrarily influenced. They are, in fact, maneuvered according to a well-defined, rule-based framework. I think that grasping this concept and understanding it can significantly affect your understanding of market behavior. So returning to the chart, it's a no-brainer at this point, especially after a second break in the market's formation, that this is a key value area. All we have left to do is to identify an entry point, which in this case is obviously this imbalance zone. The stop loss level is set higher in this area. I would like to point out that the SMA indicator serves as a helpful technical tool here, providing us with an alternative entry point if we were unsuccessful or didn't manage to secure a short position on our initial attempt. And as you can see from the chart, following the balancing of this imbalanced area, the market starts to sell off. In fact, this is followed by a strong downward move, which gets priced below the initial reaction low. Again here, the key to the decoding market vulnerabilities and manipulation strategy is to understand the dynamics of market structure and their interactions with significant price points. By doing so, you can easily spot potential manipulation and weaknesses in the market, effectively positioning yourselves for high probability trades. But does the learning stop there? Absolutely not. In fact, this next video will introduce you to another setup designed to help you spot market manipulation. All right, gang, thanks for watching. See you in the next one.